In this video, I want to talk about how to get better entries and better confirmation signals when you implement order flow to your trading. Now, not only is this going to enable us to take higher probability setups, but also it's going to take some stress off of us because we're not going to hesitate as much. And most importantly, we're going to be able to focus on better risk to reward opportunities, which then will just increase our profitability in the long run. We're going to call the first playbook a passive buyer or a delta outlier, and you're going to see why in a few seconds. Now, this trade was a 5-to-1 realized risk to reward ratio. And what that means is I risked $2,500 on this setup, meaning if my stop loss hit, this is how much money I was willing to lose. And I profited $12,600, giving me a realized risk to reward ratio of 5-to-1. Now, on this chart, we can see here we entered long at this level of interest and took profits at this upper resistance level near the high of the session. Now, we're going to call this a passive buyer because there's some significant buying activity that I spotted on the order flow that's going to enable me to get in the market as soon as I spot this order flow. So going over the plan that I posted in my community, the main thing that I was watching for on this session was for the market to break under 65.75, but not below 65.65. That if the market sells off, holds this level, which is going to be this green demand zone here, I would look to get long targeting 65.95, which again was just this upper level of resistance. Now, Carmine, where is 65.75 coming from? This is what I mean with watching delta outliers. Now, basically what we're going to see is two significant levels of interest. And how I approach the market is I never really know if the market's going to react. I never know how it's going to respond to specific activity. And this is why I favor using order flow, is because order flow will help me gauge whether buyers or sellers are active or present in the market. So in this specific example, we could see here off of this 1 minute candlestick chart, at this 933 candle, the market sells off. And what we cannot see on the charts, but we can see on the order flow, is at this low of the day, which is 65.75, right here on this red 1 minute candle, we see 850 contracts hit the bid with 850 total contracts, giving us a negative delta of minus 850. Now, if at any point any of these terms or concepts confuse you, I have a full order flow trading series. I'll post a link for this in the description of this video, kind of going over all order flow basics and how I apply it. So basically, as the market was selling off in the first 3 minutes, we see 850 contracts hit the bid, which indicates aggressive selling hitting a passive buyer. Now, the reaction after this is the market begins to rally. So this to me sounds like a passive buyer sitting at 65.75 because of the reaction in the market. We call this a delta outlier. Now, what's interesting about this is this was on, call it a Tuesday, right? The Monday, the day before this, or the session before this, at 65.75, looking at the footprint chart here, we can see essentially the same action previously. So the day before, right into the close, we see minus 550 negative delta, and we see minus 1,050 negative delta. And keep in mind, this is at 65.75, the same exact level where we're seeing it the following day bring the significant passive buying here, and the market trying to lift and rally up from this. Now, even 2 hours later, right before the close, minus 551 negative delta here. And again, this is all transacted at 65.75. So essentially what we're seeing at this point is the day prior, we're seeing significant passive buying volume. And how I indicate this as passive buying is, especially on the first two attempts, the market rallied because of this. Now, going into the close, obviously the market kept moving lower. We could see that with the negative delta bar and the increase, price action much lower. But previously, around 1:30 Eastern time and 2 o'clock Eastern time, the market did rally from the significant passive buying that we saw earlier. Now, why this is important is because we see this action the day before, and now we're also seeing it in the intraday basis on the next session. So kind of something goes off in my head and says, all right, there's some significant order flow activity at this level. Let me gauge how or if the market reacts to it. So ideally, this is where the market first got that negative delta or that passive buying where the market rallied because of it. And then here's that second one, and the market tried and kept moving down slightly from it. Now, the following session, extending the line over, we see 65.75 again. And this is where I take the setup, and this is where the trade starts developing. In this time frame, the next day, we were watching 65.75 and how the market reacts. I'm watching a break under 65.75, but not below the 65s. Essentially, I wanted this level to break, attract sellers, and whoever is transacting here from the session before and whoever is transacting here in the current session, let them buy more. For traders who have a large need to facilitate a long position in the market and for it to move up, they need others to sell. So this is kind of why my thesis shifted towards let this level break, let it attract sellers to come into the market. As long as it doesn't move too far down, this could be a good indication that a passive buyer is present and someone is loading the boat for an agenda to bring the market up much higher. Now, the market's going to sell off right here, and I get long on this candle right here. Now, obviously, you're going to know the outcome of this setup because I just explained that it was a 5-to-1 risk to reward ratio. But does anything right here, right now, indicate that the market is super bullish at this moment, right? Honestly, just looking at a candlestick chart, not looking at any order flow, the market breaks this low. It kind of looks like it's rejecting it. We're selling off, and nothing really right here, right now indicates that the market has a very strong chance of bouncing. But diving into the order flow, I'm going to show you a live replay of this setup. We could see as the market was selling off, we start seeing another passive buyer facilitating more of a buy position and buying, absorbing all of the aggressive selling. What this means is the market tried to rally here. And on this rally, the market pulls back. And as it pulls back at 65.70, again, 5 points under where this activity was the day prior and even in the intraday session, the market pulls back. And right here, a passive buyer steps into the market and the selling volume gets absorbed. We can see this by the cumulative delta. It had a negative effect, but the market rallied up. As soon as I see this passive buyer enter the market and the aggressive sellers get absorbed by this passive buyer, I get long in this exact moment at 65.70. All right, so now we have this replay up so you could see this trade unfold in real time. And what I want you all to pay attention to is the depth of market on the right. And keep an eye on 65.75. Similarly, looking at the heat map, the market's going to break under this low of day where my cursor's at. And while we break under the low of day, I want you all to watch first the significant order flow activity that is going to appear at 65.75. So keep an eye on 65.75. I'm going to put this to 2x speed. The market's going to break under the low right here, and this move starts getting absorbed. Right here, you can see 850 contracts hit the bid at 65.75. Yet the market bounces. And to me, this is a good sign of a passive buyer coming into the market, again, with what the action that we saw the day before. So at this point, the market found the bid off of 65.75, right? You see this large selling bubble down here indicating that a passive buyer was active and present. And in this moment, this is now when it becomes interesting to me to wait for a possible low of daybreak, right? Under 65.75. Let sellers come into the market. And if then the market reclaims back above this large delta outlier, which we're kind of seeing occur right now, this could be a very, very bullish indication. So watch what's going to happen here. The market's going to pull back. We're going to sell off much lower and keep an eye on the depth of market. Look, now at 65.75, we see minus 1217 negative delta. This move under the 65.75s is really now beginning to get absorbed. The market's going to break aggressively under this low of day right about here. And now I'm going to start zooming in because this is when I get very interested into the market. So it's going to break under the low. And now it's going to start trying to reclaim back above the previous low where we are spotting this possible passive buyer. Now I'm going to zoom in here. It's going to happen very, very fast. I want you all to keep a very close eye on 65.70. In fact, I'm going to go to 1x speed here. 65.70, what we're going to see here is a passive buy order step in, and you're going to see a lot of aggressive selling hit 65.70. So watch this. It's going to happen very fast, but spotting this, as soon as I see this, I click the buy button and I get in this trade long. It's not waiting for the market to move, in my favor. It's spotting the market buying activity. Watch, it's going to happen right here. We're going to see a large passive buyer step in. So on the COB column, this is the current order book. We see 519 contracts. Somebody's looking to buy at 65.70. On the depth of market, we could also see 65.70, 519 contracts. Somebody's looking to buy here, right? With the current context that we're seeing in the overall market, with the potential sign of a passive buyer, now we're really seeing a large passive buyer come into the market. So now watch. What we're going to see here is there's going to be large selling volume, and this is kind of what we saw in the footprint. Aggressive selling is going to hit this bid. The passive bid absorbed all the selling, and the passive buyer won this battle. So watch. It's going to dip again. The bid fills. We see 958 contracts hit, and more importantly, 580 at this exact moment hit that bid. That bid got filled. And when I see this action, I get long right here in this exact moment. Now, again, this in itself is not significant, but with everything that I've been leading up to this confirmation is what gives this trade more seasoning and more spice, giving it more confluence and more conviction. At this exact moment, I enter the setup. It's not waiting for the market to rally up. It's not waiting for buyers to, aggressively lift it higher. It's at this exact moment because this is offering me the best risk to reward ratio, and directly following it, right? The market rallies and multiple different attempts after the market supports 65.75 pretty much perfectly, and then eventually has all the aggressive buying and rallies up into my 65.95 target where I get all out of this trade. Now, what's important here is I am getting in as soon as I see this confirmation, right? We could see I got long 65.70 down here. Now, what I did was I put my stop loss at 65.65, which is again where that original level from my plan came from. So let's just say, going back to this position, long at 65.70, stop loss under 65.65, targeting 65.95. This is how I was able to get a little over a 5-to-1 risk to reward ratio. Now watch how differently this now dynamic comes. If you wait, let's just say for a candlestick chart to close, or you hesitate to enter because you're fearful of it to work with you or work against you, right? Let's keep the stop loss at the same price at 65.65. But now let's adjust our entry point to call it 65.75. Let's just say we waited a little bit and we waited for the market to move up to 65.75. Still an excellent risk to reward ratio, right? It's still a 2-to-1, 2.06, right where my cursor's at. Risk to reward ratio, still excellent, right? Let's just say we wait for a 2-minute candle to close or a 5-minute candle to close, right? Now our entry would be all the way up here. Now, just simply waiting and not getting in when the order flow tells us to get in, now our risk to reward ratio is a 1.4-to-1 R. Our stop loss is the same. Our target is the same. Our risk box is about equivalent to our reward box, not enabling us to have a better risk to reward ratio, but getting in when the order flow tells us to get in. When we spot that passive buyer at 65.70, this is when it enables us to get in with a 5-to-1 risk to reward ratio in that exact moment. And this is why understanding order flow and how it enables us to get better confirmations with higher probability setups that just offer great risk to reward ratios if we enter in that moment that we're spotting the specific confirmation pattern. And why this is important. Let's just say we have a 3-to-1 risk to reward ratio, which means we are going to win $30 for every $10 that we risk, giving us a 3-to-1 risk to reward ratio. By doing so, we can have a 30% win rate right here, yet still come out profitable. But if we were just to simply flip that and say, all right, we have a 1-to-1 risk to reward ratio. We risk $10 to make $10. Theoretically, we need a 60% win rate to be profitable. Or let's just say we have a 5-to-1 risk to reward ratio. We are rewarded $50 for every $10 that we risk. We can theoretically have a 20% win rate, yet still come out profitable. So you see why it's so important that if we focus on our R multiple and our risk management, it takes the position away from us we don't need to always be right. In fact, we can be right 30% of the time, 20% of the time, and still come out profitable. Versus a system that has a negative risk to reward ratio, which means let's just say we are rewarded $10 of profit while risking $70 of a potential loss, giving us a negative risk to reward ratio. If we have a risk to reward ratio of negative, right, this means we have to be right 90% of the time. And it's very difficult to attain a strategy that has a 100% win rate, 90% win rate, 80% win rate. If you do, awesome. But that means your risk to reward may slightly be skewed. The way I look at the market is that I need to put myself in the position to lose as much as possible in terms of quantity of losses, but lose the least amount of money as possible in those losses. That way, my winners, when I am actually right, can multiply the losses as long as they are small. Now, not every trade is going to be a 5-to-1 risk to reward ratio. Not every trade is going to be a 4-to-1. There's going to be some trades that might be 2-to-1, 3-to-1, right? But this still gives us where we can be wrong more than we are right, yet still come out profitable. And this is a key aspect, in my opinion, to trading, especially using order flow and short-term scalping in the market. If you learned anything from this lesson, I would appreciate a thumbs up on this video. If you're new to my channel, hit that subscribe button and also check out the links in the description of this video. But other than that, I'm ending it. Peace out.